So we started our discussion by talking about this crazy example. What if we all decided to pool our pennies and go out and buy 40% of Alphabet, which is, Google's parent company. So the day I put this together, this was sometime in 2018. So I didn't look up to see what the price was and change the numbers for today, but you get the idea. Okay, so at that point in time, the stock was trading for $1,074 a share. There were approximately 692 million shares outstanding, so that would give us a $740 billion market value. On the balance sheet date, closest to the date I pulled this $1,074 per share, the books had a book value of equity of $150 billion. Okay, so the market value of the company is $740 billion. The book value, and this is the net assets of the company, is when we refer to the book value of a company in total, it's basically the value of the equity, right? Assets minus liability. So the book value is $150 billion. So to buy 40% of Alphabet, we would have to pay $1,074 for each share. It would cost us approximately $296 billion. In terms of recognized balance sheet book value of $150 billion, with our $296 billion investment, we would own $60 billion of book value. Okay, you see kind of a disparity? Paying $296 billion for $60 billion in book value. The big question is, what do we do with the difference? There's $236 billion difference between 40% of the accounting, if you will, the accounting value of this company, and 40% of the real dollar value of the company. Okay, so that's where we get started. So the difference is called excess basis. It's almost always the case because in the real world it's very rare that the book value of equity equals the market value. It's hard to imagine an example where that would hold true because so many things impact the stock price that don't flow through the financial statement. So what GAAP says we need to do is we need to make a guess at what might be the difference. And if it's something that you can identify, then you have to recognize it as GAAP would require. So, for instance, if you can figure out an asset that is very undervalued, you have to account for that additional asset value, as if you bought a new asset, so you would depreciate that asset, so on and so forth. All right, so we just talked a little bit about what could make up that difference. So activity 5 is all about an example with excess basis in an equity method. So we start with talking about Sad Dog and Happy Pup. Okay, so Sad Dog's going to acquire 40% of the outstanding common stock of Happy Pup for $1 million. The book value of the net assets of Happy Pup was $2 million. Okay, so Sad Dog had to pay $1 million for 40%. The book value is $2 million. Any excess cost, because you know there's going to be some, was assigned to a patent, an intangible asset that was undervalued on Happy Pup's balance sheet. That patent has a remaining useful life of 10 years. Easy enough. For the year ended 2016, Happy Pup reported net income of $200,000 and paid dividends of $80,000. So first things first, we're going to have to use the equity method to account for this investment because we own 40%, right? And we're going to keep using that 40% to help us calculate some of the entries and some of the things we need to record. So let's just see what we can come up with for these questions. I'm going to move them out of the way because make them tiny so that we can have room to write. But briefly, question number 1, it says, what's the fair value of Happy Pup, the whole company, on January 3rd? So, you can kind of think of this. If $1 million equals 40% of the value of the whole company, the value of the whole company is going to be equal to 2.5 million. All right, that's an algebra question. That's basically 1 million divided by 40%. Okay, so the whole company is valued 2.5 million fair value. All right, the second question says, how much is the patent undervalued? Well, to figure this out, you have to use the information that's given about the book value, what's actually on Happy Pup's books. In total, they have a book value of $2 million. We said all of the difference between the fair value and the book value is because of this patent. So that's just some real quick math that shows us that the patent has a value of $500,000 in total. How much? Number 3 says how much. So this was number 2. Number 3 says how much of this patent difference belongs to Sad Dog. Well, Sad Dog has 40%. So that means Sad Dog has 200,000, right? Which is 500,000 times 40%. That's the Sad Dog share, if you will, of the whole thing. So then there's a question that says, when Happy Pup reports net income of $200,000, did that $200,000 include any amortization of the additional patent value? It's not a trick question. It's really a question written to make you think. Okay, so if you think about it, this $200,000 in net income, not the same as this $200,000 that Sad Dog's share of the patent. It's a different $200,000 of net income. That would have included amortization and depreciation of all of the assets that Happy Pup has on its books, but we have just spoken about the fact that by definition, the patent is not on their book. The $500,000 of value in that patent is beyond what they have on their books. So your answer to number 4 would be no. They are not including any because the $500,000 is not in their general ledger. Okay, it's not recorded anywhere. So, given that fact, what GAP says we have to do, since if we are Sad Dog, what GAP says Sad Dog has to do, Sad Dog has to account for that $500,000 patent based on the rules we know for how you would treat an intangible asset that has a 10-year life. All right? So basically what it means, whenever we recognize, Sad Dog recognizes its share of Happy Pup's net income, whatever that amount is, in addition to our share of the net income, we're going to have to recognize some amortization of the patent. Okay, so that's where this is going. All right, so then it says the journal entries that Sad Dog would record related to its investment. What a great review kind of question, because that's going to make you hit on a lot. Wow, that's going to make you hit on a lot of things about equity method investments, and it's a great review. Okay, so we're going to go ahead and look at it. So originally we said that we were going to do a record the purchase was $1 million. So this is in number 5. So we had our investment in Happy Pup for $1 million. Cash goes down by $1 million. That's to record the investment. that's one entry. I think I'm going for 4 entries total. Okay, so then we're going to recognize our share of dividends, which the problem says, blah, blah, paid $80,000 total in dividends. It's tiny. All right, so our share of $80,000 in dividends would be 40%. So we would have gotten $32,000, 40% of $80,000. And we know with the equity method, the other side would be a return of capital. So that would have been a credit to the investment account for $32,000. This is for dividends. All right, we have an entry for our share of the net income. So we just did an example with this. We know that our share of the net income is going to make our investment account bigger. So that's going to be a debit to investment in Happy Pup. It's 40% of $200,000. So that is $80,000. And the other side of this was investment income. $80,000. All right, that takes care of these. These are the same entries we did in our last example. That's going through our income statement, right? Investment income. That's the first thing that we've done that's going to go to our income statement. Okay, then the last piece is we have to do something with this $200,000 share of the patent. And GAAP says, all right, Sad Dog, you're going to have to recognize the amortization over the remaining life of this intangible asset. So $200,000 value with a 10-year, the problem tells us it has 10 years of useful life. That means it's going to have amortization every year of $20,000. So I know $20,000 is the amount for my journal entry. Rather than using an amortization account, I'm going to just debit the investment income that I just recorded. Right? I'm basically making this $80,000 smaller by $20,000. And I'm crediting the investment account. Okay, so that's my 4 entries. I'm going to get some of this stuff out of the way. I'm going to show you, just to wrap it up, what the balance in that account is going to be. Investment in HP. We had our $1 million investment. We made it bigger by our share of income. We made it smaller, just like we talked about in our last activity, by the dividends. And we also made it smaller by that patent amortization, which I'm going to call excess basis amortization. Okay, now it would be amortization in our case because it was an intangible asset. If it had been a tangible asset that was overvalued, I would call this depreciation. All right, so that I end up here with $1,028,000 in value. And there, I believe we have it. A little bit of a quiz. Just asking you for numbers. I think we're all good. All good. Got our ending balance right there. All right, so that takes care of excess basis. It's got its own little walkthrough.